Hi, this is Pete Kears for Cantissimo Senior Living. Cantissimo Senior Living was created to provide housing, education, community, and services to the senior living market. We understand the anxiety in choosing a senior lifestyle. We're trusted advisors providing free information resources in simple, straightforward language to help individuals discover vibrant, worry-free lifestyles. Check us out at CantissimoSeniorLiving.com. Cantissimo Senior Living. Experience beyond measure. This video is the sixth in a series about paying for long-term care. Among the many ways of paying for long-term care, life insurance and annuities have been growing in popularity. Let's start with life insurance. In its original form, life insurance was intended simply to pay beneficiaries upon the death of the insured. Since its inception, however, life insurance has evolved to include many additional options. Some of these options can help pay for long-term care. Option 1. Leveraging cash value. There are two types of life insurance, term and permanent. Term most resembles the original form of life insurance. It pays out a benefit at the time of death. Permanent life insurance also pays out at death, but unlike term, it also has a cash value component that accumulates money during the life of the policy. The owner of permanent life insurance policy can leverage cash value to help pay for long-term care in three ways: surrendering the policy to get the cash value, taking a loan on the policy in which the death benefit serves as collateral, and selling the policy to a third party such that the new owner becomes a beneficiary. Option 2, accelerated death benefit. An accelerated death benefit allows the insured to access the policy payout prior to death. Often included as a standard feature on both term and permanent life policies, some ADBs, as they're called, can be activated to help pay for long-term care costs. Therefore, when shopping for life insurance, consumers should pay close attention to ADB provisions in the contract. Insurers differ on what criteria will trigger an ADB payout or whether the payout is a lump sum or monthly payment. Option 3, hybrid policies. A hybrid policy, also called a linked benefit policy, directly combines life insurance policy, a permanent policy, with dedicated long-term care policy. The linkage exists because the long-term care benefit amount is tied to the premium amount paid in. For example, a $75,000 lump sum premium payment would result in $375,000 in long-term care benefits, depending on the specific policy contract language. Premiums paid into the policy are split between the cash value account and the cost of insurance. Option 4, long-term care riders. A rider is an optional policy benefit that usually increases the cost of the policy to cover additional benefits. In this case, the rider acts the same as the long-term care insurance component of a hybrid life policy. For both the hybrid and the rider, there are some advantages over traditional dedicated long-term care insurance, also known as LTCI. First, the cost of premiums is usually fixed. Premiums can increase during the life of dedicated LTCI policies. Second, the medical exam tends to be less stringent for the dedicated LTCI. Third, for permanent life policies, cash value increases on a fixed or variable basis, unlike dedicated LTCI, which has no cash value. And finally, the life insurance policy provides a death benefit as well as long-term care coverage. Now remember, any long-term care benefits that are paid out reduce the death benefit amount. But this is the defining advantage of the life insurance plus long-term care combination. A common criticism of dedicated long-term care insurance is that if the insured never needs long-term care, premiums paid are wasted. With a life insurance base, the death benefit compensates to some degree for the premiums paid. Next, let's cover annuities. Annuities pay a monetary benefit as long as the annuity owner lives. It can be an immediate type, which means income flows to the annuity owner immediately after the initial lump sum payment into the annuity. For a deferred annuity, income starts at a future date. Like the cash value component of a life insurance policy, interest on money put into the annuity grows at either a fixed or variable rate. Annuities designed for long-term care are the deferred type with a long-term care rider. The advantage of these annuity riders is if the long-term care benefit is not used, the annuity owner still receives guaranteed income. So, like the life insurance version, premiums targeted for long-term care are not wasted. Also, like life insurance, medical exam requirements tend to be less stringent. A major disadvantage of the annuity rider alternative is the upfront, usually large payment. This may be out of the question for many consumers. However, for existing annuity holders, a tax-free 1035 transfer can be made to the long-term care-oriented annuity. Payments from the new annuity for long-term care purposes are also not taxable. Despite some attractive advantages for some consumers, buying life insurance or an annuity for long-term care can be a complicated process. It's helpful to work with a trusted and knowledgeable professional to sort through all the options. This is Pete Kears for Cantissimo Senior Living. Talk to you next time.